Welkom bij een nieuwe KoersKompas Podcast. Vandaag heb ik Juliette Declercq te gast op de podcast. Zij is een heel bekende stem in de macro-economische sferen, een hele goede belegger. Juliette, welcome to the show.
Thank you very much. I didn't understand what you just said, but
Yeah, can you maybe briefly introduce yourself to the viewers?
yeah, of course. So I've got about 25 years experience directly in markets as a strategist. I've also been a trader at JP Morgan for 4 years, and although that was fun, my passion is much more in basically giving traders around the world the conviction to trade, and that's really what I like. I started after working at JP Morgan and Morgan Stanley, speaking to some of today's biggest traders. I started JDI Research, which is now like 10 years ago, and I speak mostly to CIOs, CEOs, about like 200 around the world. My focus is really on cutting the noise. I think, maybe 5 years ago it wasn't so obvious, but today it's absolutely a must to cut the noise in information and really get to the bottom of what's moving markets. And I think really getting this understanding is basically allowing me to be year in, year out, catching the 3 big trades each year that are making basically someone's P&L. I speak to hedge funds, real money, high net worth, and family offices. Really, the service is not at all focused on retail.
Yeah. I've been familiar with your work. I've been watching some podcasts and everything for quite a while now, some years, I think. You do fabulous work. You've been on the mark more than a few times here, and one thing that's in the not so distant past here has been you prognosticated a not so rosy future for equities, which has come to pass in the meanwhile. Let's maybe start off there. What are you seeing there? Because we've seen like a drawdown of like 21.5% of the S&P. Is that it? It's going to be like a Corona-like flash in the pan, quick drawdown, and all back to happy days, or is this are we on the road to something more ominous here? Is this like a bear market rally?
So I think it's already been an incredible year, and I have to say, it's very different than the Biden years. There's pros, which is obviously the tremendous opportunities that come with basically being able to analyze a completely different macro paradigm. But there's also the exhaustion of basically writing and analyzing things that basically can change on the flip of a coin, and it's making it quite hard, like in terms of like mental charge. I mean, just last week I basically spent all Monday morning writing an email to clients about why Trump wasn't going to fire Powell, and then basically just as I'm about to send the email with like some recommendations, like he basically tweets that he's not going to fire Powell, and you're like, this is hard. So I take a lot of interest into what's consensus, and I spend a lot of time finding where consensus is going to be wrong. And this is basically where you get the biggest risk reward in terms of the horizon that I look at. Obviously, when I publish a new recommendation, there is normally like a 25-pager on what I'm thinking, roadmap, and etc. So I can't just show up and be like recommending something that's like a 2 or 3 days, and for really good risk reward trade to work on a sort of like I don't know, I'd say probably a month to 3 months basis. Time and time again, you basically have to find the flow in markets. And the good news is there's always a flow in markets. I think there's a lot of there's a lot more, certainly a lot more than 20 years ago, momentum traders that are kind of like really happy when as long as momentum keeps coming to basically like trade a narrative that might be completely wrong and just basically read about the information that basically confirm their bias. So I really thrive in this kind of markets, looking for like a turn in this kind of thing, looking at momentum develop, building my stories, finding the flaws in that story, and basically publish like a trade idea that is completely against consensus, and on which the first week I basically get a lot of clients saying, what is this about? And, I disagree. And then, hopefully they really talk to me, dig into the story more and realize, okay, maybe she's on something. So, at the end of 2023, basically consensus was like massively onto like a 2024 recession. And I started 2024 pretty much like as the, maybe 5% people were like, no, actually, we're not at all looking at a recession here. We're looking at a cyclical up tilt, which is going to be driven, partly by wealth gain, but most importantly, last year was about real income gains. So what you have in markets is basically wages that form on the back of like inflations. And that's really been very true during the COVID crisis, where you'd be like, prices have gone up. I don't know. I mean, there were some years where prices went up like probably 10%. And that really gives you the backdrop to go to your boss, especially in tight markets like we've seen post-COVID. You go back to your boss and be like, look, I've lost like 10% purchasing power this year. I need an increase in wages. So you typically have like a 1 year lag between wages and inflation. So at the beginning of 2024, when inflation started to collapse, just on the back of like a positive supply shock, which was then amplified by the sort of like a oil shock that we got. Like we got a big downside in oil on more positive geopolitics in the summer of 2024. So what we had is like a big shock of disinflation in 2024, but with wages that were still running really quite high. And that's the case in the US, that's the case in Europe as well. And obviously, as a result, that's really what happened in 2024, is that basically we got no recession, we got a cyclical up tilt, we got a big shock of disinflation and wages that were lagging. And whether you were in the US and Europe, you really saw in confidence levels that it really is what was driving consumption. Now, obviously, we started. So it's quite interesting because at the end of 2024, there's always sort of like a look back function of like, well, you know what, we haven't got a recession in 2024, and everybody's got their narrative about why we didn't get a recession, and basically extrapolate it into 2025. So we started 2025 with like a huge consensus on the fact that there wasn't going to be a recession, and that Trump was like amazing for the economy. And again, I got yelled at by on the webcast or by clients on like, but no one's like looking for a recession. What is it you're seeing? And what I was saying is basically a mix of first real income deflation. So the fact that wages are now catching up and that inflation is no longer going down. And obviously that was massively amplified by the fear of tariff. So on one side, wages are still coming down and you get a shock of inflation expectations. So that's basically completely the reverse of 2024. but perhaps more importantly, we started 2024 with very depressed expectations on earnings, economics, and obviously the opposite this year, where we started the year with extremely rich stock markets, and in an economy like the US, where basically you need not wealth to, you don't just need wealth to stay the same to actually continue to get like US exceptionalism and consumption. You actually need to continue to see those returns in SPX to basically boost growth. In other words, I think there's like kind of misunderstanding in markets that in terms of growth, to get growth, you need employment to improve, not just stagnate. You need wealth to improve, not just stagnate. And you also need purchasing power to improve. So we started the year in a very fragile macroeconomic backdrop, which was basically massively amplified by Trump's stance. Whether you're looking at like you're looking at an employment market that was already weak. So if you're starting to like fire hundreds of thousands of government officers, obviously that will weigh on generally on job expectations. But if you add to that, add salt to this one by basically promising inflation as well, it didn't take a genius to know that. So that we were going to be like getting a very significant growth scare in Q1 this year, which is what I've been recommending to position for. And what I was looking for is like similar to what we had in July last year, which is basically a Fed that was really sort of like not as backward looking as it is today, but still backward looking, because there was like a lot of like weakness in soft leading indicators in July last year, which is also a time where I recommended to position for like a front end drop in US rates, and recommended also to like take profit in long Nasdaq, except basically at the end of 2024 we had this like kind of a whoosh of like thanks to like the Fed finally getting on with the weaker economic problem, with like the first 50 basis point cut in September, which sort of compensated for the fact that they were a bit late. But more importantly, we had like a massive boost in confidence from Trump election, which obviously deflated in Q1 this year. So that's the way I'm looking at the market. What we traded at JDI Research in Q1 is really stagflation, except we were very early in that process. And stagflation, basically the result is that you've got a Fed that is tied at the hips, and therefore with very rich stock markets, you really need those earnings to continue to basically get to continue to progress. We got this dip now. I think consensus has very much rallied to the stagflation narrative. What I'm looking at is, yes, consensus has rallied to the stagflation narrative, but if you're looking at what's happening in markets, stocks are still extremely rich, and there is this kind of like a dichotomy in thinking that you can now get a recession and inflation at the same time. Now, I very much disagree with that. I think that's a theme that you can trade, but in reality, if you are to get inflation, you need a supply shock, but you also need a demand shock, a negative supply shock and a positive demand shock, which is exactly what we got with COVID. And I think, during COVID, I was one of the first, and again, like very much against consensus, calling for like a burst of inflation. And I was calling from a burst of inflation from, mid 2020. And the reason is that you basically got that negative supply shock added to basically people receiving checks in the post. So you can get inflation on the back of a supply shock, but you need demand to follow. And what I'm seeing today in markets is that, of course, there is a potential price shock. There is cost pressure in the pipeline, but there is a complete divergence between demand and cost pressures. In other words, you can get inflation and strong. You can get a demand. You can get inflation, but there won't be a recession. And if you do get that price shock in market where demand is actually collapsing, what you're going to get is not a price shock, but a negative demand shock. So that's not happened. It's not been traded yet because soft data very typically lead hard data by 1 to 3 months. And so, that's the kind of thing that led Jay Powell to say, well, confidence is down, but yet people are going to, all going to buy a car. And there are like 2 reasons for that. Firstly, there is a natural lag between confidence and actual consumption, and obviously the second thing is that there's a huge FOMO sort of like buying, front loading of purchases ahead of the price hikes. Which is already what we had seen happen in 2018 in the first mandate, in the first Trump mandate, where you didn't really see consumption start to really come down before the tariff actually hit. So, all those sort of like different pieces of the puzzle make it a really mind-blowingly interesting macroeconomic backdrop to basically trade, and really what I see today is people don't understand, but when you actually do spend the time, as I do, to understand what's going on, what are the different lags between different aggregates, you can see clearly. And so what I saw clearly was like stagflation in Q1, but what I see clearly in Q2 is not stagflation. It's basically a recession that will lead to disinflation. So what I expect is that Powell is going to be able to cut, and he will have to cut much more than priced by markets. I don't see inflation. If you see higher prices, it's not going to be persistent price pressures. And so, yeah, I hope that answer your question.
Where are you on the, let's say, core to periphery view? Do you think money is going to continue flowing to like China and Brazil and all these countries here? Are they going to be the preference of investors going forward to look and
So that's a really interesting question, because something big, really big, is happening there in terms of liquidity. As you probably know, having traded recessions and markets, normally when the US weakens, the US economy weakens, you basically get a stronger dollar because the dollar is historically driven by the trade account. And so, you get a weaker US economy, basically consumption drops down and the trade account shrinks, and basically that strengthens the dollar. And the problem, and that's a big problem, a much larger problem than just what we're talking about today, is that there is therefore a direct link between a weaker US economy and weaker global liquidity. So, and the reason for that is the hegemony of the US dollar. 80% of global trade is basically done in dollar. And the problem when you strengthen the dollar is that it basically devalue pools of liquidity outside the US. And what I mean by pools of liquidity, I'm talking about basically central bank reserves, FX reserves outside the US. So you basically like deflate the value of global liquidity just by having a much stronger dollar. So as a result, global trade collapses, and that's the direct link between a weaker US economy and a global recession. And we've seen it time and time again. Now, what's really interesting with Trump is that the dollar is no longer driven by the trade account. It's actually driven by the financial account, because at the same time the US economy weakens, you actually have loss of credibility for US assets. The reason for this loss of credibility is obviously coming from the efforts made by the Trump 2.0 administration, whether it's conscious or not. Some are saying that there is really a willingness to get away from like the hegemony of the dollar and the sort of like what they call the strong US dollar policy. So you can talk about this supposed like Mar-a-Lago Accord or like Plaza 2.0 Accord, which basically would like to devalue the dollar, but goes as far as like talking about like taxing foreign interest on US treasuries, and what you're doing by that is basically lowering the credibility of US assets as a safe haven. So at the same time, the US economy weakens, and basically automatically the debt to GDP ratio will increase, right? Because debt to GDP is not just about the debt, it's also about the GDP. So you have this loss of credibility in US assets, which means that the dollar is now driven by the financial accounts. So when the US economy weakens, the dollar weakens, and obviously gold blows up, and etc. But it's got one advantage, which is that at the same time the US economy weakens, you get a balancing force in terms of like global liquidity. So that goes to answer your question. Basically, you get a weaker US economy, and you basically automatically revalues pools of foreign exchange assets outside the US. So you don't get that sort of like vicious cycle from the US economy to like, we used to say when the US sneezes, the rest of the world catches a cold. That's not happening this time. In fact, instead of being a vicious circle, it's a virtuous circle. So as a result, I think there is a strong potential that the US recession is not going to lead to a global recession. So what I'm looking at is basically to trade this kind of dichotomy between what's happening today, what's happened in the past, and use like noise and like weakness in the US economy to basically buy European assets. Now, China is a bit of a different story, but there is still that for me, the whole trade war is as much about getting, plugging the fiscal deficits via a tariff as really rebalancing global macro. So my point here is that when you've got a current account deficit, as the US has it, and you need more demand to basically plug your GDP growth need, you can basically look outside your own country. So if you basically manage to convince the big export economies like Germany, like China, if you actually manage to convince them to actually stimulate their own demand, then you've got a long race through rebalancing, and you don't need tariff as much as you previously needed them, because there is like an automatic rebalance. So, there is a point there that, yes, Trump's not managed to make America great again, but he's managed to make the rest of the world great again. And if whether you're looking at Germany or China, those are like key macro imbalances in terms of like demand that we've been pointing at for the last 20 years. And Germany, the debt break in Germany has been one main reason for European weakness as a whole. And China is a big part of that puzzle as well, where, if you stimulated domestic demand, you would be much less enslaved to US demand. So there are many different pieces to understand to that puzzle. But
would you be looking at countries like in Latin America and so on that are commodity exporters? They're probably
yeah,
not.
so you, obviously that feeds into global demand, and that feeds into global commodity prices, which in normal time would be absolutely collapsing, because as soon as you get the US weakness, you get a strong dollar, and you can basically kiss goodbye to global growth and commodity demand. This time it's much more complicated.
How high on the list is gold when it comes to your preference of commodities?
So for me, really, gold is not a commodity. I mean, when I'm talking about like a commodity,
Yeah.
I'm talking about sort of like global demand
Yeah.
led commodities. For me, gold is basically, and you can see it on charts, is completely a function of term premia on US assets. So you can see like the reason gold is exploding is basically because of a loss of confidence in the safe haven of the post-World War safe haven of choice, which is basically US treasuries.
Yeah.
So for me, that's the only gold driver. And obviously then you can look at like all the gold versus copper, or gold versus oil, or even gold versus silver, to if you really want to trade actual demand.
Yeah. Yeah. They also have because a lot you of course love these cycles, economic cycles. You must have a view on Bitcoin as well.
Yeah, I mean, that's actually something I was saying just like 2 or 3 weeks ago. I mean, in the end, I just elected to go full into European equities, which is something that is much more traded by my clients. But anecdotally, I thought, at 75,000, I was like, actually, I should probably recommend Bitcoin as well. Yeah, I mean, I don't have any issues on buying dips in Bitcoin, which I see. Obviously not all crypto are hard assets, but I do believe that Bitcoin is a hard asset that should be trading much closer to gold than, and which has definitely a term premia, or the opposite of like term premia. If you see term premia explode in the US on the back of like unorthodox policies that the current administration is trying to push, then obviously Bitcoin would explode as well.
Right.
But the thing is, I'm not. I think that's the other important thing to realize, is that I don't think when Besant or Trump like were pushing those sort of like policies of like potentially basically trying to get the rest of the world to pay for the US fiscal deficit, whether you justify it by defense, or whether you justify it by like all those export countries taking advantage of us. Really, there was this kind of like move to like, well, you know what, our fiscal deficit is not our problem. It's going to be other countries' problem. And what's really interesting is that basically bond vigilantes really came back like really quickly. And that's been one of my theme as well, is that during the years of like a post GFC world of like QE and or YCC, basically you did not have anymore like a feedback from like basically bad policy making or like unorthodox fiscal policy making from to term premiere. So that was like world of the world of like Brexit or anything you could basically invent to get away from your deficits. This time it's not the case at all anymore. The Fed is not there to protect bad policy making. Term premier are free to move, and so I think it's really interesting that we have seen term premier come back as a balancing force to sort of like the sort of policies that would not backfire. Pre-COVID, these policies would not have backfired because there was no way they could backfire. Like term premier were like -1% negative. And basically you could do anything you wanted and spend as much as you wanted, and there wasn't. And this time, markets are performing their job basically. Like traders, markets are doing a job of like gauging what is the risk as a bondholder to basically get wiped out, and which is basically what's happened over COVID, right? I mean, bondholders were like buying whatever, like Austrian 100 years at like a negative real yields, and like basically bondholders got absolutely like decimated over COVID because of like this game of like you can do fiscal and monetary at the same time. Well, those years are gone, and I think that's really what Trump 2.0's administration is really figuring out. Like, you can't have the cake and eat it all. You can't devalue US the US entities, the dollar, and basically keep long end bond yields down at the same time, which is one of their main goal. So I think I expect much more, if I may say, like checks and balance. And I think we've seen the worst in terms of like uncertainty. Now, I don't think that will preclude a US recession, but it's got a lot of consequences market-wise. So yeah, fascinating macro world.
Right, indeed, always is, yeah, especially these days.
Exhausting, but fascinating, yeah.
For sure. Also, maybe something that I have to ask: if you were to guess here, looking out through the decade here, this is guessing work, of course, but let's give it a shot here if you don't mind. The compounded annual growth rate of the S&P and let's say EEM as well, the emerging market basket. What do you think like the average compound is going to be for the rest of the decade here, looking out for the both?
I would still probably bet on the US. So I don't know, like I don't think I think there's a lot of talks about like the end of US exceptionalism. For me, it's really a cyclical force, not like a structural force. I think there is still a lot to be excited about in the US. Whether I'm not saying it will be. The US will be the champion of AI, but there is still like animal spirits in the US that you don't see anywhere else in the world. Free markets will not, I mean, Trump is, what I want to say is like, I'm a bit more, I've lived through years of the years of Brexit, being like a French and living in the UK, and what's really sort of like heartbreaking is like there is no, that's it, it's done, and that's something that is done for a long time. I mean, Trump is only there for 4 years, and that's also why. So you just have to basically look at it and be like, well, it's got to be cyclical, because unless you come out with like tariff, and I'm not saying tariff are a bad thing. I think there are a lot of what Trump 2.0's administration is trying to do, which actually have been calling for a long time. The problem is probably the way to do it. So I think there is some space to have tariff or threaten with tariff. But then, coming from one day to another with like 20% tariff on Europe out of like a completely dumb, equation is just the best way to lose credibility, not the best way to. So, and you do need that credibility for the next administration to think, you know what, this is actually making sense, and maybe we'll get somewhere on the back of that. But the way it is right now, I mean, as a company, would you reshore or like basically like open a subsidiary in the US just on the basis of tariff, knowing that, doing that capex, knowing that basically the next administration can change everything, and you're going to lose massive competitiveness on the back of like trying to build in the US. So I think that's really the sort of like it's that uncertainty and that sort of like whatever looks like a complete nonsense, which is really the problem for me, and which means that US exceptionalism is taking a hit, but it's still cyclical. I don't believe that the president of the United States has the means to basically curb Fed independence. I mean, sure, there is a risk that what is going through the Supreme Court could mean that they can fire anyone they want, but you still have like the kind of like, in 4 years, I think that's the one thing that would come back, and also there is quite a high chance that Republicans would probably side with Democrats when you're actually trying to undermine such important institutions, not only for the US dollar, but also for like global financial stability. So I am, cyclically looking for outside rest of the world assets to hugely outperform. I think we could see like still like 10-15% outperformance from the rest of the world, and I don't want to re-enter US here at all. But if you're asking about the next 10 years, I still think there is a lot to praise about US assets and US equities in particular.
All right. Yeah, sounds good. I don't really have too much questions left. I do maybe some general advice for investors out there looking at this year.
General advice, I mean, like be careful trading momentum. Be careful with like confirmation bias, because I'm looking, and that's also what I tell my clients is like, it's totally fine to trade momentum, but at least be aware that you are trading momentum, not the truth. So I would really kind of like warn clients or traders, new traders, about the confirmation bias and being like so certain about something just because of price action. Keep in mind that I'm there looking for flows in your trades and in your and that will be a shock.
And you do a great job at it as well, I must say. So thank you for
Keeping
coming on
people
the
on their
show.
toes. Yeah.
Yeah, awesome. Thank you for coming on the show. I appreciate it a whole lot. And maybe next year or so, maybe we'll do it again.
No problem. It's been a pleasure. Thank you for your invitation.
Thank you.